The Absa Bank chief executive presenting the scorecard, the good and the bad.
In light of the global macroeconomic indicators, it is now even more imperative to develop domestic financial markets to drive economic development through domestic revenue mobilization, which can be put to good use as development financing, therefore providing long-term financing for priority sectors.
The Central Bank Deputy Governor Michael Atingi Ego on the decline in foreign exchange reserves and a fall in participation of offshore investors, pointing the finger at recent capital outflows.
Well, we remained the fourth, but the score dropped from 64 to 63 on account of reduced FX reserves and liquidity that resulted from the flight to quality as offshore funds exited the frontier markets amid rising interest rates environment in their home countries. Nonetheless, it's worth noting that Bank of Uganda has embarked on several measures to sustainably build robust foreign exchange reserves.
The report scores are based on a scale of 10 to 100, and on Pillar 1, market depth, Uganda scoring 46 out of 100, access to foreign exchange 67 out of 100, market transparency, tax and regulatory environment, Uganda scoring 79 out of 100, capacity of local investors 14 out of 100, macroeconomic environment 86 out of 100, legal standards and enforceability 85 out of 100. Uganda's best performance coming as a result of increased activity in light of government debt-based investment.
We used to have only up to 15-year bonds in Uganda, and those were the longest bonds we had on the market. Right now we have a 20-year bond. We expect more on the horizon. I know that there are talks about an infrastructure bond to fund things like the pipeline that is going to boost our market depth. Going on to the second pillar, access to foreign exchange.
The report, according to economists, is a tool for policymakers to learn industry best practice in the establishment of robust financial markets, and there are positives too.
Unfortunately, Uganda wasn't one, but we'll come into details as to why that's the case, although the score only decreased by 1, which again I think is an argument that it has shown quite good resilience to these global shocks. The second point that I think is worth mentioning is that you'll see that there's a big cluster of countries that score between 40 and 60. Uganda is one of the only countries that scores above 60 in the index. There's only 5 in total.
Finally, Uganda scored low as shown in the report, indicating pension funds remain below the index average.
And so one of the uncomfortable truths is that here in Uganda, pension fund assets per person across the entire economy, when we average it out, are less than $150 per person. That's not going to be a very comfortable retirement for many Ugandans. Contrast that with some of the countries that are leading the pillar, like Namibia, where pension fund assets per person are more than 4,000, and that highlights one of the areas in which Uganda can probably do better.
Next one, which is very interesting, and this comes from interest rate. Why should a government issue a 15, a 10, a 20-year bond at 14, 15%? Who in his right mind is going to lend money on a venture capital when I can actually buy a government bond and be comfortable? Which pension fund manager is going to raise the wealth of his members?
Is this why you promised to take up golf?
And do that. So structurally, what is it in our government, in the way we govern ourselves, that we can lend what an interest risk-free instrument at 16%?
According to the index authors, Uganda must boost the capacity of local investors, liquidity in markets, among others.